Thanks, Angelica. This is Nav Mathur, and happy to be here and present on the connected data revolution that is going on in credit risk management. And today we are. This is more of a business-focused presentation, business and architecture folks primarily is a target audience here. And we are not going to delve a lot into the technical details of that we typically do with other webinars and talking about Cypher and those sort of things. We do have a very interesting demo as well as part of this that I think you will enjoy and it'll bring home sort of the point we're making around connected data and credit risk management. So primarily what happened in 2008 after the Lehman crisis, there was a lot of governmental regulations tightening up. Banks today, need to have a thorough and systematic understanding of risk calculations and the associated lineage, or how the data goes back to the authoritative source. And where the data originates and how it flows through all the enterprise systems. This presentation will also discuss, how connected data and graph database technologies are transforming risk reporting in modern banks, and also how it's helping them meet the stringent demands of compliance around risk reporting. At the same time, these forward-looking banks are also uniting their data silos, right? So they're using this opportunity to really bring together the data silos into an information foundation for building new and innovative applications, so that these solutions provide visibility and deep analytical insights that help improve their compliance efforts and also their risk management around the day-to-day decision making. So that's kind of the focus here of this presentation. So getting into the agenda here, we're going to talk about the regulatory maelstrom that has hit financial services in the last few years. I will talk about how graph databases apply to the situation. We'll talk a little bit about BCBS 239 compliance and key factors that are required to comply. Then we talk a little bit about the fundamental review of the trading book, which is another sort of compliance regulation that is coming up very fast that needs a risk management platform. And then we get into a scenario around credit risk management to just illustrate the point of risk management. And then we demo that particular scenario. And then we will talk a couple of case studies where banks are using this technology to innovate around risk management. And then we'll summarize with the next steps. So today's financial services regulations are truly dizzying. If you look at this, banks have to deal with a lot of these regulations and keep track of them and manage reporting around it. And in a lot of cases, there's a lot of intersecting points in terms of the data around all of this. The risk needs to be calculated frequently and often as per the new regulations. And I'm going to go through each of these regulations one by one, and there's going to be a pop quiz at the end of this, right, of this webinar. So be prepared and follow along. I'm just kidding. It's a lot of acronyms, and even some of them, I'm sure the banks are also kind of trying to decipher each one in detail. They have teams working on each one of them separately. So anyway, they have to deal with a lot of compliance regulations, and we've taken a few here and sort of just organized it. So you have Basel, the Basel Accords, 1 through 4, which is focused around capital reserve requirements based on banks' investment profiles. You have BCBS 239, which basically calculates a value at risk metric and then reports that, and so a lot of risk aggregation as well. And then the fundamental review of the trading book is also around trading desks, trading books and banking books, and how trading desks need to reserve capital based on the risk levels that they're trading at. And then you have CCAR and so on and so forth. But so those ones in green are more focused around risk. The ones in blue, like GDPR and MiFID II and CAT 10MS, they are more focused around transparency of information and fair use of data. And then the last couple of ones in that reddish color are around money laundering and foreign tax compliance. So basically moving money around. What is common across all of these, right? So from a why does graph technology apply to all of these regulations? So if you look at one of the common themes across these regulations is getting to the bottom of the data. So how is the data that you're reporting connected back to its origination? Where did the data originate from? How is that risk being aggregated along the line? And so tracking that data lineage is a key factor in most of these regulations. This data lineage can, as you will see with the examples downstream in this presentation, can be several hops. So it could be 10, 15, 20 hops or even more, and it's a web. And the data lineage doesn't stay constant in some cases. There's always trading activity going on, there's new price points coming in, and so this lineage is fairly dynamic, but needs to be maintained for reporting purposes. The risk aggregation goes the other way. So while lineage is going backwards to the authoritative source of the data, and you can imagine sort of what happened in the Lehman crisis, the credit default swaps, were packaged and forwarded on and bought progressively by other banks and so on. But it lost the original mortgages, the original addresses of the houses, and all of that. So when somebody bought a credit default swap, they really didn't know what the underlying risk factors were. Where were these homes located? In which location? How was that location faring overall in the housing market, right? So all of those things now need to be tracked so that we don't have this mess again in the future. And the real-time risk aggregation then goes forward. You're aggregating risk as you go forward and keep packaging these further into more derivative offerings, right? Temporal consistency is another key factor. This is where you're reporting as of a particular time. So when you have databases, and you have data that's constantly moving from system to system, generally speaking, today we're not keeping track of when the authoritative source changed. You're only keeping track of that at the authoritative source, but progressively as data moves, you have, in a pretty standard practice in Oracle and other relational databases, you just have a last update date, right? And that's not the actual time that data changed. It's the time where the data was changed in that system, but it may not be the same time that the change of data happened in the authoritative source. So the reason why that is important is that all the different parameters that go into the calculation of the risk need to be accurate as of a particular time that the report is being produced. And that's very, very key. Risk analytics, finding clusters of data so that you see some congregation. These type of analytics are really helpful to understand fraud and other such segmentation of your customers, segmentation of the risk, things like that. And then visualization of that risk model. What are all the factors going into the risk model? Can you actually visualize that? Can you ensure that there are no false positives in that model? And that is very key. Compliance reporting obviously is required across the board. And then governance of the data. This is obviously ensuring that there is an authoritative source for every piece of data that is going into your report, that there's a data steward assigned to that, to each piece of the data, and there is a governance practice around, how that, how you are sort of processing that data, what are the transformations that the data is going through, and keeping track of all of those. So these are all sort of key factors in all of these regulatory compliance requirements, and graph technologies is the right technology to really bring this to bear in a real-time fashion. If you're new to graphs, we have a lot of other webinars and content. If you go to YouTube/Neo4j, you can get a better understanding, a deeper understanding of what graph technology is. This webinar is not focusing on that, but assumes you have some basic understanding of graph technology and graph databases, which are special kind of NoSQL databases. So with that, we'll talk a little bit about BCBS 239. And a lot of you may have seen a picture of BCBS regulatory principles around data aggregation, risk reporting, supervisory, and governance and infrastructure. The point here really is that one of the key asks of BCBS is data lineage, and having accurate and reliable risk reports require a clear understanding of this data lineage. Reporting entities must be able to provide how each number in a report is generated, including its calculation details and where the source data is coming from. And each transformation must be attributed to an owner, a steward, and profiled with a quality and latency status. Most importantly, data must be traced backwards until its lineage ends with an authoritative source. So that is key. Data silos are prevalent in businesses today, and the lines of business often grow their own systems to meet specific business needs. So there is a need, clear need why these data silos exist. But producing discrete data silos that make that tracing of data and data lineage very, very difficult. So you must be able to trace the data movement through these silos and systems all the way back to the original sources. So this is where graph database comes in, where you essentially are building sort of the metadata or the scaffolding on top of the data silos and connecting them together so that you're able to then report across the silos. There's also terminology differences that happen across business groups in an organization, and most definitely across companies. And so you have things like legal entity identifier that is a regulation that has come in to help with that. But again, graph databases can provide a really good view of how terms are related to one another, what are the neighboring terms, so that there is no confusion as to when you are getting a piece of data, you're clear as to what it means, if it needs to be broken up, and so on and so forth. And obviously, data consistency and latency is extremely important as well, because the data has to be consistent, as I said, as of a particular time, and it has to be time-stamped, changes have to be time-stamped, and then assembled back together for reporting needs as of a particular date. So these are kind of key areas of BCBS 239 where data lineage is required, and graph databases can play a significant and a pivotal role in making sure you get quick and timely reporting, and also manage the value at risk calculation in fairly real time. And of course, the graph database will play in the governance and infrastructure bucket in terms of ensuring that the data architecture it supports the requirements of BCBS 239. So moving on, we're looking at now FRTB compliance, which is fundamental review of the trading book. This is part of this is originally part of Basel III set of reforms, but because banks are not ready, they're facing a lot of challenges with mapping all of this data. This has been pushed into Basel IV now. But essentially what it is the banks maintain a trading book and a banking book. And what was happening is trading books require higher reserve requirements because they're more volatile assets that they're constantly trading. Banking books are assets where they're held to maturity. So this could be things like, corporate loans, which don't generally turn over very quickly. A trading book would be things that are options or stocks and derivatives and things like that banks keep trading very frequently. So the reserve ratio in the trading book and banking book are fairly different. And what banks were doing was moving trading book entities to banking book to make use of the lower reserve requirements, and that in turn meant typically higher profits because the more capital that you invest, the higher returns that you expect. So that practice is being sort of outlawed with the FRTB regulations, and in order to sort of go through that, banks must maintain a risk model, and they need to get this risk model passed by regulators. So to develop this risk model, banks need to backtest it 10 years, and then in the past that was enough, but because market changes are happening, markets are moving very fast. Now the regulations require you to not only backtest, but also maintain that testing posture continuously. So you're required to sort of have 24 price points every on an annual basis that you maintain, and you need to ensure that continuous backtesting is happening. So once the regulators approve that risk formula that you have submitted, you can use that lower reserve ratio based on the risk level that you have identified for your trading desks. If you fail, however, then you are saddled with a higher capital reserve ratio, which is sort of the default that the authorities, the regulators give you. So banks are really trying to get their internal risk modeling done and get it approved and maintain that. So that's a key driver to ensure higher profitability. So this is kind of what the lineage looks like then for this type of compliance. So you have typically a trading desk, let's say an energy trading desk or a technology trading desk, and that desk will have lots of different stocks and commodities and all kinds of instruments that they trade in. Some of those things may be directly priceable, like Tesla stock. But there may be other things that are more sort of a basket. So there could be a batteries basket, for example, or a solar basket, and that's like a sub fund or a separate fund that is being managed separately. That might be part of multiple trading desks. So batteries basket could belong to the energy desk and also the technology desk. Now these desks in hedge funds and banks are fairly independent. They have their own strategies, they have their own risk models, and so forth. And then these batteries basket then translates back to the underlying stocks, and which may be equities or indexes that are priceable. So basically, the point is that you have a series of packages or these funds that then translate back to underlying priceable instruments, and you have to keep a lineage of all of that. And not only that, you have to then track it back down to individual price points, which is, as I mentioned, 24 price points in a year. And as you can see that these stocks and baskets are continuously changing with trading activity. Money managers, fund managers are selling and buying these instruments constantly. The prices are moving on a daily basis as well. So that lineage is fairly dynamic and needs to be maintained across the board to ensure that the back testing happens. So if you look at this problem, it is exactly a graph. And the best technology to actually implement this data lineage, and then the calculation of risk forwards and the aggregation of risk forwards back to from the individual prices up through the funds and to the trading desks is a graph technology, a graph database. If you look at the bigger picture as well, there are, as I mentioned, multiple silos across the bank. So there might be multiple data silos. Each trading desk might have their own systems. The basket and fund management could have multiple silos as well. Then there's trade and position data. There is the core banking applications. There's a loan application, loan systems. And then market prices and so forth. So we're talking about a lot of data that is spread across globally in a large global bank or a hedge fund. And all of these things need to be brought together. And traditional technologies like data warehousing and data lakes don't cut it, because they don't have an accurate real-time picture of risk. So what is needed is something that stitches all of this data together using the metadata, and that is the graph database, and bringing all of this together and being able to do it in real time, not only the lineage, but also the risk calculations. So as I mentioned before, that tracing the lineage is going from left to right, from trading desk down to the prices, and the risk is being aggregated upstream from the prices back up to the trading desk. So let's talk about the credit risk management scenario here. This is more along the lines of BCBS 239 and calculating value at risk metric. But we will illustrate that through a specific scenario around credit risk management. So we have a fictitious bank called Royal Albion Bank, RAB, which does business with 50% of mid to large Canadian firms. So this is a bank in Canada, and it's a global bank, and has different relationships. They have several different departments around lending, around brokerage, around mutual funds, advisory services, and each of those have relationships to different firms in Canada, but they never have, but they could have brought all of that data together across all of these companies in the different data silos to really get a good picture of how these companies are interrelated to one another, to be able to calculate risk on the loans that they have outstanding, right? So they also get market data from third-party sources that comes in. So all of that can be brought together to really solve this problem, where today they have a loan management system that is essentially bringing data in from all these silos, but each individual analyst also have their risk calculation worksheets, and then you have they're working on earnings per share forecasts of each of the companies that they follow, and then they're putting it into a forecasting system. So it looks a little bit spaghetti here, but what happens is that when market events happen, like a large oil price drop, for instance, these events cascade down through several companies based on the contractual or supply relationships that they have. And it becomes difficult to really understand that cascading risk, because the loans that you have may not be directly related to firms that are dealing with oil necessarily, but an oil shock can cause changes downstream to companies that are nothing to do with oil, and then that can affect your loans. So that's kind of the scenario that we're going to model here. So we have 5 companies that we modeled. So one is Heritage Energy, that is dealing with bringing oil out of the oil sands in Alberta. We have Aurora Refinery that's refining the oil. We have Boreal Engineering that has the engineering systems and machines that have been deployed at Heritage Energy to extract the oil from the oil sands. And then we have Hull Staffing, which provides staffing services to Boreal Engineering. So they have staff at the site at Heritage working on some of the engineering equipment. And then we have Rockies Rail, which is a railway that's transporting the oil from Heritage Energy to the refinery. And then you have the oil price. We have 2 loans outstanding that RAB has with Boreal Engineering and Hull Staffing. And then there's a lot of market data that is coming in around stocks, ratings, 8Ks, 10Ks, etc., stock prices, and so forth, that is being imported into this bank on a regular basis. So we have these relationships between, as I mentioned, so Heritage has contracted to Aurora to refine the oil. Heritage is also contracted with Boreal to extract the oil from the oil sands. Boreal, in turn, has contracted Hull Staffing to provide some of the staff at the site. And then we have Rockies Rail that is being contracted by Heritage to again move the oil from the oil sands at Heritage to the Aurora refinery. So as you can see, there is no direct relationship between the oil price and Boreal Engineering. The impact to Hull Staffing and Rockies Rail of any oil price movement is at least 3 steps removed. And it would be sort of very difficult to discover that without having this connected pieces of information. And then we have other relationships as well. So besides the contractor relationship, you can also see that Boreal Engineering owns some part of Rockies Rail, so that's an ownership relationship that's also modeled here. So it just complicates the picture a little bit as well. The things that you see in yellow there are the stock prices, are the stock symbols of these companies. And then, so this is kind of the full picture in terms of the loans that are outstanding to Boreal and Hull Staffing, and then all the relationships across the different companies. Now, what we will show here is how movement in the Brent crude price is going to actually affect the loans outstanding with Boreal and Hull Staffing in this demo. And then this is kind of the really simplistic model of that has been implemented in our graph database that we're going to demo here. So we've modeled analysts that cover a set of companies from a specific sector. So in this case, we have analysts covering oil and gas, and then a second analyst, Alice, that covers oil and gas equipment and services sector. And the companies have been basically divided across these two sectors. And each analyst maintains an estimated earnings forecast and assets for the companies that they follow. So what we will show you here is that in the demo now is that typically what happens is it takes a couple of quarters when such a shock happens in the market for credit rating agencies to really understand the nature of the cascading risk. And by the time that risk cascades 2 or 3 levels down, it is about 2 to 3 quarters out when the credit rating agencies lower the ratings on these companies based on the earnings releases and so forth. And that's when the banks know that there might be a problem with a particular loan. But what you will see with this scenario is within a matter of days, you'll be able to see how that risk cascades down to the underlying companies and how it affects them. And you can take action based on that much earlier than the credit rating agencies. So let me introduce you to Nir Avrahamov, who is our solutions engineer that is going to be helping me here with the demo. He put this together for us.
Hi, thanks for coming today. I'm Nir, and I'm a solutions engineer working at the solutions team here at Neo4j, working on some of these demonstrations of these solutions and trying to help bring to life the image that we are trying to paint here.
Cool. So why don't you get started, Nir? So what Nir is doing is logging in as Alice. She's the first analyst, as I mentioned. And as you can see, this is our little application here that we're demoing. On the top left, you have the highest risk loans. So we have a pretty comprehensive data set here. So we have about 1.5 million companies, right, Nir? Mm-hmm. And we've got, and these are real companies for the most part. We've added a few fictitious companies to just illustrate the demo so that there are no hurt feelings based on what we are showing here. And we're able to essentially mock up about 10,000 loans across 52 different industry groups here. So it's a pretty comprehensive data set that we're using. And all of this that you're seeing is live, real time, and no smoke and mirrors going on here. And we'll be happy to kind of maybe in a subsequent webinar get into some of the technical details. But here we're showing more of a business view, more of a business application, and what that might look like. So this is kind of what an analyst desktop might look like. They have the highest risk loans based on the companies that they're following on the top left. Then you have a risk chart, which is showing sort of these loans and how the risk levels have been changing over a period of time. And then you have a search grid here, which you can search for different companies. Just type in and then hit search. And it's really snappy. And then you have a graph essentially that we can center on any given company that we search on, and we can move the graph around. We can look at different relationships. We can look at different levels. So as Nir started with 2-level relationships, then he has moved to 3 levels. You can go to any arbitrary level and bring that up in the graph, and you can see all the relationships across the different companies that have been put together here based on all that siloed data that was brought in from the different silos with different relationships that the different departments in the banks have with these companies. But bringing all that data together and then complementing it with market data helps build this picture. And then down below, you can actually get the details of any given company. If you double click there, you get sort of the general information. You get financial information on what the stock price is, what the earnings per share is, and so on. What is the credit rating for that company, which is a direct bearing in the loan. And then you have where we have loans outstanding for those companies. You get loan information in the right panel. what's the loan rate, what's the loan term, remaining payment, and so on. And most importantly, what is the risk score of that loan, right? So as we can see with house staffing, the risk score is right now 74%. The credit rating is A, so loan is looking pretty good. They have the ability to pay and so on. But let's see how this scenario develops. Nir, do you have anything to add?
No, that's pretty well covered.
Great. So let's go to step one. So let's now log in as Bob as well. So we're basically going to show you two analysts that are working on two different sets of companies, and we'll have them side by side to just make sure that you get a view of that. So we will basically simulate a market event. So Nir is going to just simulate that, bring in market data. And as you can see, Alice just got an alert. So this alert is essentially saying that the price of Brent crude has just dropped significantly from $37 to $22. And maybe Aurora Refineries and Heritage Energy are impacted because those are the companies that are directly connected to the price of oil. Those are essentially oil companies, and Alice is following the oil and gas sector, right? So Alice is trying to figure out what to do, but meanwhile, there's another market event that happens. And as you can see that we have basically, there's a press release that Heritage Energy has released that is saying that because the price of oil has dropped significantly, they have halted production because essentially their production price is much higher than the current price of oil. So it doesn't make sense for them to produce oil at this high price when oil prices have declined significantly. So they're shutting down production of their oil sands. That has now impacted a bunch of companies, as you see, that are related to Heritage Energy. So now Nir has clicked on that. He's got the three stocks that get impacted immediately, and then Alice has decided to change the Heritage Energy earnings per share, as looks like this event may last a significant amount of time. So she's changing the annual earnings forecast from 6 million for Heritage Energy to 2.8 million. So this is kind of what analysts do. They're tracking their companies, they're modeling their risk, they're modeling what their earnings per share is expected to be. And so Alice is just following the companies that she has been assigned. And now we're going to model another market update, right, Nir?
So we also tune in here on Bob's dashboard, where we see that he's also received a few alerts.
Yeah, Bob has received a few alerts as well. So we can see that Bob is following Boreal Engineering, which Alice is not following because Boreal is a engineering and services firm. So because Heritage Energy is affected and there is a contract with Boreal may also be affected. So Bob has got that alert. So Bob is going to now, I guess, change the earnings forecast of Boreal from 4.43 million to 2.21 million, because Boreal is also going to be impacted because of the shutdown of the oil sands production. And as you can see, if you go down here, that it automatically recalculated the earnings per share based on the earnings and so on. So the risk score gets recalculated each time these things change. So you can see that the risk score now, Bob just got another alert that the risk score has changed from 100% to 79%. So the risk, there is an added risk to that loan. But the loan is still pretty good. I mean, 80% level is still pretty good. So we keep moving on and going to the next market update. And as you can see, the graph is moving as well. The graph based on the timeline, and maybe you can show some of the features here. So you can actually turn off certain companies in the graph, so you can focus on one company in the graph. Sort of the scale adjusts itself. So it's pretty cool how that works. And soon what you will see is that when the loans become more risky, they start showing up at these highest risk loans and start bubbling to the top. But let's go to the next market event.
And just for those of you who may not have noticed, we can see here that these organizations that are being charted in the graph correspond with our highest risk organizations in the list to the left here. So if we look, we can see that this right here in this red line corresponds with lowest risk score of the AB1 Group Incorporated. So we'll continue to move forward and we get another market update.
Yeah, so here we see that Alice has now got an alert that says the Rockies Rail stock price has dropped from 8.48 to 2.75 and may require further examination. So essentially what is happening is, okay, that whole risk event is in the market has started playing out. So it is now cascaded down from the oil price, from down to the refinery, down to the engineering company, down to now the railway as well. So the market is always aware of these things, and the risk is cascading sort of as time passes in fairly real time across all of these companies. What we are going to do now is we're going to have Alice look at Rockies Rail and maybe remodel the earnings per share there, because obviously the railway itself is having to shut down. She's realized, because all it was doing primarily was transporting the oil from the Alberta site to the refinery. And if the railway shuts down, it's going to now have negative earnings. So it'll go from 0.6 million to negative 0.24 million. And again, the earnings per share then also is negative 2 cents. And so once you see that change, now let's go to Bob and see what's happening there to the loans, right? So as you can see, the risk score for Boreal Engineering now has changed. So we didn't do anything with Boreal Engineering. We just changed earnings per share Rockies Rail, but the risk score of Boreal Engineering has gone from 79% to, what is it now? 39%. So that's a significant drop. And that is because remember, Boreal Engineering owns stock in Rockies Rail, right? So there is a 25% ownership there, and that has again impacted Boreal Engineering. So not only are they impacted directly because the oil sands shut down, but also, I guess, indirectly through Rockies Rail being shut down. So they get a double whammy here. I think that's the power of the graph, really. And you can see up in the chart, the risk chart, you now see Boreal Engineering appearing as one of the highest risk loans. You can see that in the left panel as well. And this is real-time dynamic alerting that's happening. So let's move forward with the demo. We're not done yet. So next step, we get another market update that happens. And This time Bob gets an alert on the company he's following, Hull Staffing, that their stock price has also dropped from 23 to 15, because obviously Hull Staffing is providing staff to Boreal to work on the site. So all that stuff has been idled. So obviously it's going to impact Hull Staffing. So what happens here now, Nir?
So here we're going to want to change the forecast of Hull Staffing, since we've looked at our network here of organizations, and we can see we already know Boreal is not doing so well, and we can take a look at this network and see this strong dependency between the two organizations. And we may say that if Boreal is earning less money and they've got less projects to work on now, that contract is going to heavily impact Hull Staffing, and we'd like to reduce their earnings by a little bit. So we're going to drop those earnings down from 0.5 to a negative 0.05 million per year.
So, all right. So essentially, I think in the interest of time, what we'll do is, I think you get the picture here. We're a little short in time, but essentially, as we go down this demo a couple more steps, you see that the loan picture is getting pretty bleak for both the loans here with Boreal and the staffing company, and you start to these loans become very risky. But the credit rating agency has still not come in and offered any updates. So what you start to see is that we have already kind of figured out that these loans are risky. So at this point, the bank can go ahead and resell these loans. They can to unsuspecting other banks that don't have this level of tracking and risk management. They can recall the loans. Typically, loans have covenants to recall in certain cases. They can take some action, right? But once the credit rating agencies in a subsequent step, a couple of quarters down, come in and lower the credit rating the credit ratings of these companies, then it's too late, because at that time, then these banks will, these companies will either file for bankruptcy or some sort of protection, so that they don't have to repay that loan just so quickly, and the banks will be left holding the bag. So this is an early warning system, much better risk management system that helps in making sure that the banks are up to speed on how this risk is cascading across these companies, even though some of these loans have nothing to do with the actual market event that happened, like in this case, the oil price move. So hopefully you got a taste of that through the demo. So moving on, let's talk about a couple of case studies and how some of the leading companies, some banks in the world are using Neo4j in innovative ways in this area. All right, so we have a very large global 500 financial services firm that is using us to build an online data distribution and knowledge-based platform. You can see sort of their knowledge graph, which is what this is termed as, linking all of these different companies together, as we showed in our demo as well, into a graph. So this financial services firm actually, uses this graph internally for their own analysts, as well as sells this data outside to the outside world as a data set that they could use to complement with their own data across these companies, right? So they can answer then questions like, what data sets and attributes do they have? How are these data sets related? How are these companies related? Which consumers or which analysts are using which attributes? So which companies are they following? So they have a good picture of that. And then, how is this data being transmitted back and forth across the companies that subscribe to this data. So they chose Neo4j to put this together instead of Oracle because of the flexible schema, because they can continuously add new attributes, they can continuously add new companies, new industry segments into this and grow this graph over time. And as the graph grows, the value of the data grows not linearly but exponentially. I mean, you can do a lot more with the added information, right? And so it's really, really useful for risk management purposes and understanding how each company is related to another company through their contractual relationships, supply relationships, owner relationships, which company is a competitor of another company. All of those relationships are modeled here. Given what they're doing today with this, they're expanding their plans and offering this data set to other parts of the bank and adding additional entities into this graph to make it a much bigger linked graph. So it's a very innovative use using such connected data in the first time to really assess risk and provide their analyst knowledge base to work on. This is another company in the East Coast that's again a global financial services firm that is using real-time risk assessment of breaking news, which is very, very close to the demo that we showed you, where you have breaking news events that cause a lot of stock market volatility. Their system then predicts potential impacts of these events on stock prices and associated portfolio exposure, which is kind of exactly what we showed in our demo. And the designers of the system, were trying to answer questions like how a mine explosion that spikes copper prices that affect the stock of Apple. As you know, Apple is a very heavy user of copper, and in turn, a lot of this is also used in batteries, and cobalt is also a very precious metal that Apple is using for, as well as Tesla, for all the batteries and so forth, and Samsung and so forth. So these are commodities that these companies track, and analysts that following these companies track on a minute-by-minute basis, because it has a big impact on the movement of the stock prices and the earnings per share of these companies. This application then sells real-time alerts to the phones of money managers and risk managers. This is something that has surfaced at the highest levels of the organization. The CEO of this bank hopes that we digitize this bank in this fashion, and he's hoping that we'll make all of this data available to the customers as well, and that will help them gain market share. The SVP of the Innovation Center under which this was built, his quote was that these analysts really, they don't want to be caught off guard, and this type of data really helps them be on with up to the minute changes in what's happening in the market, and have a tool that they can use very effectively to model risk. Even though this is at this point fairly small for this really global financial services company in terms of revenue, but they are really expecting this revenue contribution to grow and add a lot of value to them, even though they don't directly charge for this product, but the value that they get from the data and helps them make the right decision at the right time will definitely add a lot of business value and profitability for them. So to summarize and conclude, Neo4j and Graph Database really is pivotal and essential for today's risk management and compliance. Hopefully you saw that the data is highly interrelated, highly connected. Tracing the lineage of risk factors back all the way to authoritative sources is a key element of all these regulations and risk management. And with so many hops involved and complex relationships involved, a graph database is the right technology to really handle that. And of course, visualizing and visualizing those risk models, making sure that they are accurate and consistent and temporally consistent is as well key. And being able to model risk in real time is essential, because risk directly relates to the capital reserve requirements. And if you can maintain that risk level at a lower level, your capital reserve requirements are also lower, which in turn means higher profits. And modifying these models to keep pace with all the changing market conditions and organizational changes, the graph database will really help you do that and recalculate risk almost instantaneously across the chain, and ensuring compliance and reporting in a consistent, accurate, and timely manner. So these are key aspects of graph databases that really help ensure that you have a very strong risk management and compliance practice within your organization. So to learn more, there are a few white papers and other content available, at neo4j.com. If you go to use cases, and under that there is privacy, risk, and compliance, where all of this data and content is housed. Please feel free to make use of that. And also happy to engage with you on a brown bag meeting. Where you can kind of, if you enjoyed this webinar and want to learn more, get your team involved, get them to understand the complexity of risk management and compliance and how graph databases can help. We can bring your team together for a brown bag that we can host. You can go to neo4j.com/brownbag and just send me a note through that, and just mention this webinar and that you're requesting a brown bag. You can also request time from me and other members of our team to review your project or initiative or data model. Happy to do that. You can contact me directly at nav@neo4j.com, and we're happy to do a demo for other members of your team as well, if required.